Happy New Year, Theta Gang! It's Mikey Millions tuning in from New York City, where I'll be crushing bottles of Bacardi, playing naked ping pong with hookers, and wrestling the Bull of Wall Street for the next 48 hours. In light of my absence, my partner in crime resolved to put together a video on the next Theta Gang strategy, the short straddle. For those involved in Theta's Discord, you'll know the author of this video as Mr. IV. He's our resident late-night expert on option strategies of all shapes and sizes, and he's got a tremendous amount of experience in the market since he's been trading since he was too young to legally do so. In this video, he'll be presenting the short straddle, showing you what happens when you sell a call and put at the same strike expiring on the same day. There's no one better to introduce this strategy, so I'm very happy that he's decided to lend his time to this channel while I roll dice with Gopniki and Queens until the ball drops. Now I warn you in advance, if you're not familiar with selling calls and puts, then you are not ready for this video. I'm putting cards here for the videos on calls and puts and dropping links in the description for anyone who needs to educate themselves before they progress. And now, with no further ado, it is my pleasure to hand the reins over to the one and only Mr. IV.
Hey Theta Gang, Mikey's at the market doing some serious research for the channel, so he asked me, Mr. IV, to cover my favorite option strategy, the short straddle. We covered how with a call credit spread, we make money if the stock stays flat or goes down, and with a put credit spread, we make money when the stock stays flat or goes up. If we were to remove the safety wing to these trades, we increase the total profitability and its range. The trade-off is the risk. Mikey covered cash-covered puts, but I wanted to show you how it looks compared to a put credit spread. It behaves identically on the call side as well. By taking more risk, we get more tendies and a higher chance of being in the profit zone. A straddle is merely selling both the naked put and the naked call on the same strike and expiration. In Mikey's earlier video, we learned that cash-covered puts can be a great way to collect premium. But if the stock dips below our strike price, we're responsible for buying 100 shares of the stock at that strike price. In this example, selling the $5.50 at the money put on GameStop would collect $37 in premium. But what if Trump were to impose tariffs on the PlayStation 4?
They have to stop playing games because they're just playing games.
GameStop going to zero would mean we'd be on the hook for buying 100 shares at the $5.50 price, costing us $550, as those shares would be all but worthless. But what if we were to do a similar trade on the call side? By selling the $5.50 at the money call on GameStop, we'd receive $30 in premium. While a stock can go to zero, there is no limit to its upside. Let's say my man Billy G is trading in his old as shit Xbox, but accidentally leaves a bunch of Microsoft shares in the Halo case. It happens to the best of us. Now that GameStop owns part of a real business, it could go to $10, $20, or even higher. There isn't a way to cash cover your calls, since we don't know what the upper limit is, but you can use margin. For this trade, our brokerage wants $334 in cash and margin as collateral. Okay, we got both the put and the call side taken care of, so let's put the straddle to the test. Our favorite stock, AMD, as I'm recording this video, is trading at $41. By selling the February $41 call and put, we receive $660 in premium, or about 16% of the lot's underlying. That 16% represents our profit range, or how far in either direction the stock could move, and the straddle will remain profitable. We will also need to keep $440 of our account's buying power as cash for collateral. This amount represents what the max loss would be 95% of the time based off of implied movement. One other note, because both the call and the put cannot be both in the money simultaneously, the amount of collateral needed for a straddle is the same as selling just one side independently, so the straddle doubles your leverage to help you attain your personal risk tolerance. After the trade is executed, we're going to be in the money on one of our options throughout the duration of this trade. Since we don't want to be assigned or be short stock, a straddle always needs to be managed before expiration. When I manage my straddles, I like to think of 3 distinct profit zones. Tendy Town is when your straddle's value decreases by 25%. You may be tempted to go for more profit, but the guys at Tasty Trade have done some impressive backtests on straddles. By closing at 25% profit, you can typically get out of a 45-day straddle in 3 to 4 weeks. Increase your winning percentage to nearly 80%. An added benefit, you will exit the trade way before gamma accelerates and volatility spikes in the last 14 days of an option's life. This frees up your buying power to make other Theta Gang plays. I've linked to their study in the description. Not every trade leads to Tendy Town. Nugland is where you walk away with less than 25% profitability and less than a 25% loss. You'll be dreaming about Zaxby's, but macking on Tyson's. Most of our trades will touch Nugland at one point. Now, unlike condors, straddles can take us to a very dangerous place for options. Ramen Stan is the shithole of infinite losses. Straddles can go south really quick, so let's go over how to take profits on winners, manage losers into winners, and prevent your account from blowing up on one bad trade. The best case scenario in a straddle is when a stock goes flat, and theta decays the value of both the call and the put. This isn't like the condor, where there's a zone where the option would expire worthless. Remember, we are guaranteed to have one leg in the money, and that leg has probably gained some value since we opened the trade. Holding near expiration is more of a directional bet than a theta play. As soon as we can close both legs simultaneously for 25% profit, we're going to exit this trade. So on our AMD straddle, where we collected $660 in premium, if we can close for a $500 or less debit, we are cashing in our ticket to Tendy Town. Both the call and the put have a 1/3 chance of breaching our break-even point. This means that 2/3 of the time, this trade will be significantly in the money and unprofitable at least one point. Interestingly enough, when unmanaged, this trade expires profitably 2/3 of the time as well. This isn't just about having iron hands, it's about knowing how to manage losers into winners. By moving the untested leg out to the current trade price, you can collect even more premium and increase the chance of this trade ending profitably. You'll want the credit to be greater than the width of the inversion. The downside to this management is that you have lowered the max profitability, as the debit to exit this trade now contains intrinsic value between the call and the put. I like to do this if the break-even has been breached and there are more than 14 days left in the trade. If there's less than 14 days left in the trade, you can either buy back the straddle and take the profit or loss, or ride it out and hope theta decays quicker than gamma accelerates. This can be very risky, as you essentially have a FD that is betting against you on top of a deep in-the-money naked option. While you will win the majority of these, the daily swings in these high gamma days will be extremely volatile. I did this on Roku earlier this year when I had a $105 straddle where I received over $2,500 in premium on a single 45-day contract. Within 4 weeks, the stock was near $150, and my straddle would have cost over $6,000 to buy back. While I left this trade unmanaged, if I was trading in a smaller account, I would have been margin called. Instead, I was able to wait out a bad earnings call, get some IV crush, and buy back the straddle for a small profit right at expiration. Now that we've covered straddles, the question is, which should we trade? Condors or straddles? The Iron Condor can be done with small accounts on platforms like Robinhood. You only need $1,000 to trade 50-cent wide condors and win bigly. The straddle requires level 4 options and significant capital. Much like box spreads or the infinite money glitch, you can't trade these anymore on Robinhood. You'll need a big boy account on a platform like Thinkorswim, Interactive Brokers, or my personal favorite, Tasty Trade. If we can get 20 people to use our referral link and make a minimum deposit, Mikey and I will get a free trip to Chicago and possibly have Theta Gang featured on Tasty Trade's live stream.
Hey guys, it's Mikey chiming back in. What Mr. IV said there at the end is a very real opportunity. If 20 people sign up to Tasty Trade using his referral link in the description and either deposit or transfer an account worth $2,000, then he and I will have an opportunity to head to Chicago, tour the Tasty Trade HQ, and potentially even be on the live stream. If you're one of the folks who's ready to upgrade from Robinhood to a more serious brokerage that does not get sued by FINRA for screwing its clients, then this would be a great opportunity to hook up with Tasty Trade while also supporting the channel. You can start your new year off on the right foot by rewarding yourself with a Tasty Trade account. And lastly, Mr. IV is running his own 10K earnings challenge on his channel. His first trade in the series already moved more money than I have in the first 7 episodes of mine, so make sure to check out his channel for some high adrenaline action as well as options education. Anyway, that's all for this video. A big thank you again to Mr. IV for taking his time to put this straddle video together. I hope all your 2020s are blessed with dank trades that bestow upon you fat stacks of cash. Thanks for watching everyone, catch you next time.